So in Ind AS number 1, what we cover, okay, financial statements and its presentation model. How do we present the financial statement? So financial statement means balance sheet, statement of profits and losses, statement of changes in equity, statement of cash flows, notes to account. Okay, notes to accounts will have any significant accounting policies adapted or changed everything. These are called financial statements. General purpose financial statement. These are called general purpose financial statements. Okay. A balance sheet, as at the beginning of the preceding period, when an entity applies an accounting policy retrospectively or makes a retrospective restatement of item in its financial statement, or when it reclassifies item in its financial statement. They followed a normal procedure, not as per NDAs. They have not adapted the proper accounting policies represented in NDAs. Then suddenly from the previous year, we supposed to follow all these accounting policies. Means you have to restate the prior period balance sheet also by applying the same policies. For example, the previous year 24-25. From this year, we want to apply what? New policy, new AS. Okay, any accounting policies mentioned in AS supposed to be followed here. Then automatically, you have to restate 23-24. You might have prepared using the old model or old policies is now restated by applying the new accounting standard for the year 23-24. Restated. After that, you can present the financial statement for 24-25. Then it seems to be easy one to compare. For example, inventory could be valued under FIFO method or weighted average method. For a long period, we followed only FIFO method here. From this year onwards, we are supposed to start following weighted average pricing method. Suddenly, you could not change. Of course, you can change from here. You have to give the note that we have changed the policy. Not only that, in this year, the stocks are going to be revalued at a WAP model and restate the financial statement also. So this one will be the restated financial statement by applying the new accounting policies, and 24-25 is the first year of applying the new policy. Okay, the balance sheet at the beginning of the preceding period, not the current period, prior to that, should also be prepared when an entity applies an accounting policy retrospectively. For the last 3-4 years, we want to apply the changes, then you have to prepare preceding period balance sheet also in a new format. Makes a retrospective restatement of items in the financial statement when reclassifies item in its financial statement. So while reclassifying, this will be also provided. Entities may provide additional information on a voluntary basis, such as environmental reports, value-added statement, human resource statement. These things also be presented. These are called general purpose financial statements. Apart from that, environmental reports, how far we are supporting the environmental development or preservation, conservation, and all. So you may see that in Coca-Cola and Pepsi, we are conserving water resources by planting so many acres of trees. Okay, in case of ITC, we have depleted so many acres of trees for manufacturing our products like note and everything. To replace this, we have again started constructing the means forest and all. So that is called environmental reports. What value you have added because of this year's operations, what human resource power you have with you. So that will also be stated additionally. This is the general purpose. This is needed means voluntary basis you can supply this. Also prescribes minimum disclosure requirement in the financial statements. Applicability. Now, this Ind AS number one preparation of financial statement is applicable for profit oriented businesses, okay, including public sector business entities. And apart from that, any entities preparing CFS and SFS as defined in the Ind AS number 27. CFS, consolidated financial statements, as well as separate financial statements. When a company has majority shares in the other company, business combinations and all, they have to prepare a consolidated financial statement as per Ind AS number 109 as well as 103 business combination. Apart from that, while preparing the consolidated financial statement, they have to report their own individual financial statement also, that is called SFS. So they have to prepare these two. While preparing these two also, this Ind AS number 1 is applicable. Okay, but not applicable for the condensed financial statement supposed to be prepared as per Ind AS number 34 interim financial reporting. Once in every 3 months, you have to prepare the financial statement in a condensed matter. Not full value will not be disclosed there. In that case, this Ind AS number 1 will not be applicable. Clear? And general features of financial statement. So while presenting the financial statement, true and fair presentation should exhibit. Okay, the presentation should exhibit the true and fair presentation, adherence to the going concern assumption. So while preparing the financial statement, you have to follow strictly with that the company is having the going concern assumptions follow, and accrual basis of accounting, materiality and aggregation. Materiality and aggregation. Any item seems to be material, that should be disclosed. And if you want to disclose by adding in total only, it seems to be material, then it should also be added and in total you have to disclose. Usually, no offsetting. Offsetting is prohibited. So, assets and liabilities should not be offset. For example, you may purchase an asset in hire purchase. The value of the asset being 1 lakh, the amount payable for this asset to the hired vendor may be 60,000 rupees. You should not offset this, and showing 40,000 as your asset in your balance sheet is prohibited. How can you show? This is not right way. Asset value being 1 lakh and amount payable to the hired vendor being 60. That's how you can show. This is called showing as it is, not offsetting. Similarly, income and expenses should also be not offset. For example, interest received may be 1,000 and interest paid being 2,000 rupees. You should not show. Cancelling this and showing only interest expenses being 1,000 is not allowed. Similarly, discount allowed and received. Discount allowed 100, discount received 50. You should not offset that. So usually we should not offset as per the new accounting standard here. Frequency of reporting. Usually the financial reports are shown once in every year. Annually it should be shown. And better, you need to give the comparative information. Current information and previous years details should also be presented. Whatever the accounting policy you follow should be followed consistently. So this is what about the general features of financial statement. Okay. Hope you'll be now able to understand these cases. So what will come under general purpose financial statement? What about the voluntary basis of disclosure, applicability, and when it is not applicable? Similarly, general features of financial statements. And what to be disclosed here under Ind AS number 1. Any accounting policies you followed will be disclosed properly related to the measurement basis as well as policies used. How can you measure the value of the assets or liabilities or expenses you've shown in your books? What mode or format you have followed to measure this one also be disclosed, and what policies used also be disclosed in case of significant nature is there. And sources of estimated uncertainty in respect of the assets and liabilities and their nature also be shown. Any uncertainty that should also be disclosed. Third one being capital management policies, qualitative, quantitative aspects with respect to the assets and liabilities and capital should be disclosed, especially capital management, especially capital. Information regarding puttable financial instruments. In case of puttable financial instruments, you have to give the information. Puttable means we have given the guarantee to somebody else. Whenever he wants to sell, I have to purchase. This is called puttable, callable and puttable. So if I offer it to sell, then you have to purchase. This is called puttable. It's my commitment. The market value may be very lesser, but once he plans to sell to me, I have to purchase at the predetermined rate. I told him whenever you sell, I can buy at rupees 100. But currently the market price is only 60. Though it is 60, if the seller is willing to sell for 100 rupees or exercises his option to sell for this shares and whatever it may be, I have to purchase at 100 rupees. It's called puttable financial instruments, call option and put option. This call option and put option you will study at your final level, but here you need to understand puttable is nothing but option to sell, call being option to buy. So I have the option to sell XYZ company as well as A. A is having the put option. Put option. So as per the put option, A has the right to sell. Right to sell at what? At a prefixed rate. The prefixed rate being 100. Assume. That's called strike price. A has the put option, otherwise right to sell for 100 rupees with the XYZ. It means whenever A wants to sell, XYZ has no other escape, for no other option to escape. He has to definitely purchase. At what rate? 100 rupees. If this share price currently selling in the market rupees 60, what happens then? No other way. A may sell this to XYZ, and XYZ must accept this one for rupees 100. So XYZ purchases for 100 and sells in the market for 60. The company is going to be loser of 40 rupees. This is called puttable options. Okay. So what happens in case if you book a bus ticket reservation, you did the reservation for rupees 500. Okay, exactly on the at the time of the journey, the price of the ticket is inflated to 1,000 rupees. Though it is 1,000 rupees, you paid only 500 rupees and you agreed to travel and reservation is confirmed. Your seat is confirmed whether the market price is 1,000 or not. I have to sell or I have to offer the ticket for 500 rupees only. This is also a part of puttable. No other option. If you want, then I have to give at 500 rupees only. Market rate maybe 1,000. That's called puttable option. It's a liability for the company. And apart from that, other disclosures also we have should be disclosed in the form of notes like any proposed dividend per share, the amount of cumulative preference shares not recognized, to the extent of cumulative preference shares not recognized, amount payable to the preference shareholders remains unsettled. The preference dividend not paid for more than 2 to 3 years should be payable. The domicile and legal form of the entity, domestic company or international company. What about the legal form? Is it LLP or public limited company or private limited company? All these things should be disclosed. The description of the nature of the entity's operations and its principal activities, the name of the patent and ultimate parent of the group, the limited life entity. If it is a limited life entity, information regarding the length of its life. Usually, going concern assumption will be there, right? So you form the company only for 3 or 4 years only for a temporary purpose. Once the objective is reached, then they will simply close this. In that case, it should be intimated in disclosure form. So these are the small points you have to understand in case of NDAs number 1. We will now move on to the NDAs number 2. NDAs number 2. So in case of NDAs number 2, it's what about the calculation of inventories. Calculation of inventories. Let me try to finish up the illustrations first and then theory later. So how do you value the inventories? You might have studied in your means preliminary level as well as inter level, in school level also, like FIFO method, LIFO method, and all methods we have. Similarly, the valuation state, cost or NRV, whichever is lower. All these things are now structured and stated. This is the method you have to follow in NDAs number 2 principles. Like so, by solving the illustrations, you can very easily understand what are the principles available in NDAs number 2. Okay, inventories may be raw material, work in progress, as well as finished goods. Sometimes you have spare parts, machine spare parts and consumables also. Now you have to understand how to value for the raw material, work in progress, finished goods and all separately. Okay, as well as in case of spare parts, if we have, as well as consumables we have, how can we value? Right, let's start with first illustration. Now, valuation of work in progress. Valuation of work in progress. Always remember, cost, the value is equal to whichever is lower of cost or NRV. Whichever is lower of cost or NRV. Cost of the partly finished unit at the end of 22 being 150. This will be 150. Cost to date not completed in case of valuation of work in progress. As on today, I have spent around 150 rupees for this work in progress. Then what about the NRV of the work in progress? NRV of work in progress. NRV of work in progress is nothing but sale consideration minus expenses to sell. Expenses to sell. Not only that, it's a semi-processed form. You know what could be the further cost you spend for finishing this? Okay, estimated further cost. Estimated further cost to spend. Further cost to complete this. Cost to complete. If you subtract these two, then you will get the net sale consideration. This NRV is consideration compared with the cost to determine the value of the work in progress to be shown in your balance sheet. The unit can be finished next year by further expenditure of 100 rupees. To finish this, we need to spend another 100 rupees. The finished unit can be sold for rupees 250. Once the goods is ready, we can sell it for 250. Subject to payment of 4% brokerage and selling price. Automatically what happens? 4% you have to pay the brokerage for the sales price. In the sales price being 250, 4% on this being 10 rupees, I think. Am I right? So 10 rupees you have to spend. Assume that the partly finished unit cannot be sold in semi-finished form itself. We cannot sell it as it is. We have to spend the further cost to complete. Only then we can sell. 250 minus 10 minus 100, then ultimate value being 140. This 140 being NRV. Now, the value at which it is going to be shown in your book being only 140, not 150. Though you spend for 150 to manufacture up to this level, you have to show as only 140. Okay. So, we have completed this aspect. This aspect is over. Clear? Next illustration. Absorption of fixed overheads. How can you calculate the cost of production, sir? Cost of production can be calculated this way. Direct material, direct labor, direct expenses. All these things put together the prime cost. Am I right? In case of manufacturing overhead or factory overhead, production overhead, variable overhead should also be addable and fixed overhead should also be addable. In case of variable overhead, based on the actual capacity, you have to find out per unit cost and you can add. So, total variable overhead being 1 lakh, actual number of units produced being 10,000 means you have to divide this by 10,000. So, you will get 10 rupees. 10 rupees is the variable overhead. Is that okay? This 1 lakh is the actual variable overhead denominator. Actual capacity used, actual capacity, production. In case of fixed, you know, actual variable fixed overhead divided by whichever is lower of full capacity and actual capacity. Actual capacity. Is that clear? For example, fixed overhead being 1 lakh. Clear. Full system capacity being 10,000, but actual capacity is only 8,000. Then this 1 lakh is divided by what? 8,000 rupees. Come on, tell me cost per unit here. Is it 12.5? Suppose full capacity is 10,000, actual is 12,000. Now, how can you divide? 1 lakh divided by 10,000. Between these two, whichever is lower will be the denominator value. So, 1 lakh divided by 10,000, 10 rupees is the fixed overhead. So, after calculating, if you add, then this is called cost of production. Okay, prime cost directive can take variable based on the actual capacity can be taken, but while calculating the fixed overhead per unit, you have to calculate the fixed overhead per unit based on whichever is lower of system capacity, full capacity, actual capacity utilized between these two, whichever is lower is taken. ABC Limited has a plant with a capacity to produce 1 lakh unit. This is what about the system capacity. And the expected fixed overhead is 18 lakhs. Fixed overhead being 18 lakhs. Find out the value of the stock if units produced are 1 lakh 90 or 120. This is actual. How do you calculate? The same formula is going to be used. So, first case 18 lakhs divided by system capacity or actual capacity, whichever is lower, both are same. So, per unit fixed overhead being 18 lakhs. Sorry, 18 rupees. 18 rupees. And in this case, 18 lakhs divided by system capacity 1 lakh or actual capacity 90, whichever is lower will be taken. So, 0.9 lakhs, then the value being 20. And the last case 18 lakhs divided by system capacity 1 lakh, but actually is 120. Between these two, whichever is lower will be taken 1 lakh. So, 18 will be the answer. Uh, I think I made a mistake. Whichever is higher will be taken. Sorry, whichever is higher. Stand corrected. Okay, please make a correction here. Whichever is higher. In this case, 1 lakh divided by 12,000. What is the value? 8.33. Am I right? So then here 18 lakhs, 1 lakh and 1 lakh, whichever is higher, 1 lakh. So 18 rupees. 1 lakh and 90, whichever is higher, 1 lakh, 18. 1 lakh and 1 lakh 20, whichever is higher, 1.2 lakhs. Then the final answer is 50. I stand corrected. I stand corrected. Here 10. Here 10. Okay. 10 or 8, whichever is higher, 10 will be taken. So 1 lakh divided by 10, 10 rupees will be the answer. Now, from this, one more point to be noted here is, what about the absorption? What about the absorption? Absorption being 18 rupees per unit, actual production 1 lakh. So 18 into 1 lakh, 18 lakhs is the absorption. And what about the second one? 18 rupees per unit, 90,000 units only produced. So 90,000 into 18, 16.2 lakhs is an absorption. The difference between these two, 1.8 lakhs, is under absorption transferable to the P&L account. This is transferable to the P&L account. In case of under absorption, 18 lakhs is the fixed cost, but we recovered from the customers only 16.2 lakhs. If I charge 18 rupees per unit from the customers for the actual production of 90,000 rupees, I could have recovered only 16.2 lakhs. Another 1.8 lakhs remains unrecovered. That unrecovered is a loss. How can I adjust this? It can be debited direct to my P&L account. The last case, 15 into 1 lakh 20, 18 lakhs. There is no any under or over recovery. Clear? Now, clear? Text me, online students, come on, make it faster. Now, next one. Now, retail method of valuation. Retail method of valuation. Under this method, how do we calculate? Opening stock plus purchases, opening stock plus purchases. From there, sales is subtracted to find out the closing stock. But you have to find out all this value at selling price. From there, you have to subtract the GP on stock. Then you will get the closing stock at cost. This is called retail method of valuation. A trader purchased certain articles for 85,000. He sold some of the articles for 1,05,000. Okay. The average percentage of gross margin is 25% on cost. Okay. From the closing stock, GP is subtracted to get the closing stock. This is sales price, this is cost price. If the cost being 100, GP is 25. Then what about the sales value? 125. Clear? Opening stock of inventory at a cost of rupees 15,000. Find out the cost of closing inventory. 15 plus 85. Okay. I think these things are given at cost. Opening stock 15,000, purchases 85,000 are at cost. Clear. But you need to know what? You need to know what? Sale price. This is cost. I need to know sale price because from here to here, we have to post at the sales price. If cost is 100, then it should be 25%. Otherwise, 4 rupees cost means profit should be 1 rupee and sales price should be 5 times. Do the cross multiplication. 15,000 being 4 times and 1 time should be 3,750 and this should be 18,750. 85,000 is a 4 time and 1 time being 21,250 and this will be 96,250. Then overall value being 1,20,000. Am I right? Get me the value. 1,15,000. 1,15,000 or 25? 1,15,000. This one is 106. 106. Okay. Then it is 25,000. From there, 1,05,000 sales is subtracted, then closing stock being 20. The closing stock, what you arrive here is at sale price. If sale price being 125, cost is 100, then do the cross multiplication, probably 16,000, and GP being 4,000 rupees. This is the format for calculating valuation of stock under retail method. Retail method, adjusted selling price. Adjusted selling price. First half calculated at selling price. If selling price information is not given, cost price, then you have to convert everything into the selling price. Finally, from there, GP is subtracted to get the closing stock at cost. Clear? If it is clear, text me. We will move on to the next one. Joint product and byproduct. In case of joint product and byproduct, how will you handle? You might have studied in your process costing. The same logic will be available. In process costing, okay, joint product and byproduct, the byproduct value will be adjusted to the other products. The same happens here. In a manufacturing process of VJ Limited, one byproduct BP emerges besides two main products MP1, MP2 apart from scrap. So that gets scrap and byproduct and MP1 and MP2. Two main products are emerged. Right. Now, in a joint process, at the end of the joint process, we get two main products, MP1, MP2 and one byproduct. And the amount spent for the joint process being this much. Raw material, wages, fixed overhead and variable overhead. Come on, tell me. 3 lakhs 40. 3 lakhs 40,000 is the joint process cost. Now you have to identify out of the 3 lakhs 40 how much is for M1, M2 and MP. Okay, we have been given the output also. 6,250 units produced. 5,000 units were produced. 1,600 units were produced. In case of byproduct, it could not generate profit sufficient enough to, or sales revenue sufficient enough to adjust its own fixed, means common overhead. Usually, you know, whatever the NRV we recovered by selling the byproduct will be subtracted from the joint cost of 3 lakhs 40 in this case. Average market price of MP1 and MP2, this may be saleable at rupees 80, this may be saleable at rupees 50. Byproduct being at the rate of rupees 25. There is a profit of 5,000 on sale of byproduct after incurring separate process charge of rupees 5,000, packing charges 6,000. Okay, apart from that 6,000 was realized from scrap. We get scrap also. Now, by selling the scrap, I get how much? 4,000 rupees revenue is there. 6,000 rupees, sorry, 6,000 revenue is there. And this byproduct, there is a further process cost, 4,000 and 6,000. 10,000 rupees. So separate process charge 4,000 and packing charge 6,000, 10,000 has gone off. 10,000 has gone off. Of course, there's a profit 5,000, you forget about the 5,000 rupees. Now, you subtract the amount recovered by selling the byproduct NRB. How much is that? 16 into 25. 40,000. From there, further process cost is subtracted. Come on, get me the value. Hope you'll be getting 30,000 rupees NRV. From the scrap NRV, we get here being NRV from byproduct, NRV from scrap 6,000. What is the ultimate value? The ultimate cost after this being 2 lakhs 4,000. So we find out the overall unabsorbed cost. We cannot equally distribute the cost to all the products because byproduct is not capable of taking this much of cost. Rice and rice burn. Rice is capable of absorbing the common process cost, but burn cannot be. Rice burn cannot be possible. Is that okay? That's a byproduct. Whatever the maximum benefit we can enjoy from that can be subtracted from the common cost. It's your cost rate. This 2 lakhs 4,000 is the cost for M1 and M2. Can be segregated to M1 and M2 using their either output units or value. So I assume I'm going to share this using the value. In case of value, what happens? M1 6,250 into 80. What's the sales value? 5 lakhs. For this 5,000 into 50, 2.5 lakhs. So this 2 lakhs 4,000 will be shared in the ratio of 2:1. Okay, 3 lakhs 4,000. This is 3 lakhs 4,000. Now this 3 lakhs 4,000 should be distributed to MP and M2 in the ratio of 2:1. Sales value being 5 lakhs, 2.5 lakhs. In that ratio, you can share this. For M1, 3 lakhs 4,000 into 1 by 3. For M2, 3 lakhs 4,000 into 2 by 3. Now this value be this one is 2, this one is 1. Okay. 1 lakh 1,333, 2 lakhs 2,667. This you might have studied at your costing level itself, right? But based on the sale value of M1 and M2, we can distribute the common costs. Overall cost, from there you can recognize or realize the byproduct value and scrap value realized after the cost. Okay, NRV is subtracted. So balance 3 lakhs 4,000 is the joint cost allocated only to the main products MP1, say M1 and M2. While allocating these two, you can either use the unit or value, but predominantly we are going to follow the value, sales value. Is that clear? Now we'll move on to the next illustration. How will you deal with the following as per NDS number 2? On 31st March, the closing stock of X Limited includes 13,000 units costing rupees 14 per unit, but current market price being this much. In case of finished goods, cost or NRV, whichever is lower will be taken. Current market price being 12, cost being 14, you can take only 12 rupees. How many units are there? 13,000 units. This will be the value in case of finished goods. Is that clear? Next question. Imran company deals in manufacturing certain product. It gives you the following information for the year ended 31st March 2013. With respect to the closing stock of these items, this is the actual cost to be used for purchasing this, and this is NRV. Now, how can you calculate the value? Cost or NRV, whichever is lower of cost or NRV, will be calculated for every category of item. Every item. 25 or 19, 19 will be taken. 62 or 60, 60 will be taken. 15 or 21, 15 will be taken. The overall value being 94 lakhs. Am I right? 94. Okay. What about independently? Come on. Historical cost of XYZ. 102 and NRV being 100. Actually, in this examination, Imran company valued the closing stock as 100 rupees, 100 lakhs worth. Is it correct or not? That's how the question is asked. This valuation is not correct because we have to value every category of assets independently. Item wise valuation. Item wise valuation. This is not correct. But in this case, I directly gave the two answers, means two values, and whichever is lower of these two values for X, Y, Z item separately calculated. Now, how can we calculate the work in progress stock? Already we have studied. What is that? Cost or NRV. In case of work in progress, NRV, cost means cost to date. NRV is nothing but sale value minus any expenses to sell. Expenses to sell. Not only that, further processing cost. Further processing cost. This will be called NRV. Now, Luxor Limited deals in three products A, B, and C, which are neither similar nor interchangeable. At the time of closing of its financial account for the year ended 31st March 2015, valuation of closing stock of the said product is to be determined. The details of closing stock of the three products extracted from the records of the company are as under. Cost of material, production expenses incurred. So, this is already incurred, means expenses incurred. Selling and distribution expenses to be incurred, estimated selling price. This is supposed to be incurred. Supposed to be incurred will be subtracted from here to get the NRV. So NRV is nothing but the difference between these two will be the NRV. And cost to date is nothing but adding of these two will be the cost to date. Is that clear? Cost to date being 1,20,000, 55,000, 1,50,000. NRV being 150 minus 10, 1,40,000, 50 minus 5, 45,000. And 180 minus 20, 160. Now, between these two, whichever is lower will be taken. So, whichever is lower of cost or NRV will be the final value. Here, 120. In this case, 45,000. Last case, 1,50,000. Clear? Total 3,15,000. Now, we'll move on to the next one. Valuation of stock in trade, whichever is lower of cost and NRV, the same sum. Men's Limited purchased goods at a cost of rupees 20 lakhs in October 2014. Till March 31st, 2015, 75% of the stocks were sold. Then, cost of stock. 75% sold, then we may have only 25% goods in our hand. Then the cost being 5 lakhs. The company wants to disclose the stock at rupees 5 lakhs. So out of 20 lakhs, 75 sold means balance 25% stock remains unsold. At the purchase cost, it is 5 lakhs. The company wants to disclose the value of the stock being 5 lakhs. The expected sale value being 5.5 lakhs. And a commission of 10% on sale is payable. So any commission payable should be subtracted. 10% being 0.55 lakhs. Then 4.95 lakhs, what you get here is called NRV. Now, NRV here being 4.95 lakhs. Now, compare these two, whichever is lower will be taken, that lower being 4.95 lakhs. 4.95x. What the company followed is not acceptable, cannot be acceptable. Now we'll move on to the next one. C, valuation of raw material. Valuation of raw material. How do you value the raw material? Cost or NRV. Whichever is lower of cost or NRV will be the method usually follow. Provided the finished goods what you manufacture using this raw material lost its sales value. Otherwise, sale price of finished goods decreases. Then this will be correct. You have the wood, steel and all. The cost of wood being 1 lakh. Okay, using the wood you can manufacture the table and whatever the furniture may be. This is raw material wood. Finished goods being table. At the time of purchasing the raw material, the cost of raw material being 1 lakh, finished goods sale value being 5 lakhs. Suddenly what happens, raw material value falls to 70,000 only. What about the finished goods value, sir? There is no any decrease in the finished goods value. Still it remains same 5 lakhs or further it may be having increase also. Then what about the raw material value, sir? Raw material value being 1 lakh only. Raw material value being 1 lakh only. Because if the raw material, how can we value the raw material worth? If the sale price of the finished goods manufactured using this raw material value remains constant or increasing, same or increasing, then value will be equivalent to cost only. Cost only. Suppose the value decreases to 70. The value decreases to 70. Okay. Value decreases to 70, but the finished goods value is 3 lakhs. Finished goods value decreases, then cost or NRV of raw material is compared between these two, whichever is lower will be taken. Hope you will be now able to understand. Clear? So raw material value will be undervalued to the extent of NRV only when the sale price of the finished goods manufactured using the raw materials value decreases. If that value is not decreasing, don't do any adjustments. You don't do any adjustments. The cost of production of product X is 450, which is which includes per unit cost of material, labor, overheads. This is finished goods cost. The raw material value being 250. This 450 includes 250, 110 and 90. Finished goods is manufactured using raw material labor and overheads 250, 110, 90, 450 is the cost of finished goods. Raw material in that being 250. At the end of the accounting year, the replacement cost of raw material is 210. NRV being 210. Today, the value of raw material is 210. There are 500 units of raw materials in stock. Calculate as per IND number 2, the value of closing stock. Scenario 1, the finished product is sold at rupees 420. Finished product is sold at 420. 420 means what happens? Originally selling price 450, now decreases to 420, then decreases. In that case, cost of raw material 250, NRV being 210, whichever is lower will be taken. Scenario 2, finished product sold at rupees 490. Originally 450, finished product is not decreasing, it is constant or increasing. In that case, raw material value being 250, we never bother about the NRV of the raw material. NRV of the raw material. So whenever we supposed to value the value of raw material, always cross verify with the finished goods value. If the finished goods value is decreasing in the market, only then raw materials value will be adjusted to the NRV, else you can show at cost itself. Cost itself. Now let's move on to the next one. Valuation of finished goods. Determine the value of the inventories in the following cases. Material cost 100. Direct labor for manufacturing finished goods 20. Direct variable production overhead 10. And fixed production charges. On normal capacity of 1 lakh unit, normal production capacity. What is the actual? Actual information is missing. So actual or normal, whichever is higher will be taken. So you spend 10 lakhs rupees, we assume that the actual is lesser than the normal capacity. The normal capacity in this case being only 1 lakh. So divide this by 1 lakh, so 10 rupees will be the fixed overhead. Overall value being 140. 140. How many units are there currently as stock? 2000. Then what's the final value? 2 lakhs 80,000 rupees. Next, what happens in case of abnormal loss, sir? What happens in case of abnormal loss? In a production process, normal waste is 5% of input. 5,000 metric ton of input were put in process. Input 5,000 metric ton. And in a wastage 300 metric ton, cost lost minus what loss should be subtracted? Normal loss should be subtracted. What is the normal loss here? 5%. 5% will be subtracted, 250. Sir, 600 metric ton lost, sir. Yeah, the difference between these two is called abnormal loss. Any loss due to the abnormal issue cannot be recoverable from the customer. We can recover only to the extent of normal loss. And cost per metric ton of input being 1000, so 1000 into 5000, 50 lakhs. Now 250 units lost, so 4750 unit will be the normal output. We should not compare the actual output here. For the normal output of 4750 units, we estimated 50 lakhs will be the cost. Then what about the cost per unit? So 50 lakhs divided by 4750. Then cost per unit being 1052.63. This one also you might have studied in your process costing, right? In case of abnormal loss, abnormal gain, how do you calculate? You calculate the cost per unit is equal to the normal cost divided by normal output in the absence of abnormal item. Abnormal item will not be considered. Is that clear? Now, let's finish up the theoretical background of inventories. Ind AS number 2. Ind AS number 2. To prescribe the accounting treatment, what are the objectives? Accounting treatment prescription. Determining the cost. Subsequently, how do you recognize? Okay, cost or NRV, whichever is lower. Write down the value to the NRV if it is required. Provide guidance on the cost formulae also, formulas. Cost formula is nothing but assigning the costs to the inventory. Okay, so cost formula is nothing but this one. That what you learned already in your costing is called cost formula. In case of cost formula, you know, it's nothing but a method of computing the cost. If the cost being not interchangeable or interchangeable, that's how you can understand. In case of not interchangeable, specific cost associated with the goods purchased is the cost for the goods. Is that okay? Now interchangeable, then we have two options. One is historical cost or actual cost is spent. Another one being non-historical cost. Non-historical cost. In historical cost, we either follow FIFO method or weighted average pricing method. In non-historical cost method, we either follow standard cost or retail price method. Retail price method also we discussed. We calculate the closing stock at selling price, from that GP is subtracted, which is called retail price method. So we have these other methods. Let me first finish up what is called interchangeable, what is called non-interchangeable. So when it is all about petrol in the bunk, they purchase in tanker and fill the petrol in the bunker. First around 1 lakh liter petrols purchased at the rate of rupees 100. Again, second lot they purchased another 1 lakh liter at the rate of rupees 101. Now, can you distinguish the petrol in the tank as petrol for 101 rupees purchased, petrol for 100 rupees petrol? No, gets mixed. If you pump out 1 liter petrol from this tank, okay, we cannot guarantee it is for 100 rupees petrol or 101 rupee petrol. Petrol got interchanged. Is that okay? So naturally, then how can we price that, sir? Either you can follow the FIFO method or weighted average method. So you can either follow FIFO method, means first you 100 recover from the customers. Next you can recover 101 from the customers. Once the 1 lakh liter is over, next 1 lakh liters when you start supply, you can charge 101. Rather than that way, we can simply go for the weighted average method also, where the price is more fluctuating. Always the price showing increasing trend, it's better to follow FIFO method. If there is no trend, then we can follow weighted average method. So these are the two recommended methods we have for interchangeable case. This is nothing but the actual cost. Actual cost I spend for purchasing first 1 lakh liter of petrol, another 1 lakh liter petrol purchased for 101. This is the actual cost. So whenever we take the actual cost, it is called historical cost. Historical cost. So here the historical cost is taken. Sometimes rather than historical cost, we can go for standard cost. We never bother about the actual cost. We'll finalize the standard cost based on actual cost divided by normal capacity, normal output. Last we have seen now in case of abnormal situation, we can we calculate the cost for normal output, and based on that we'll recover is called standard cost. Even sometimes we can depend on the retail price cost also. These last two costs is not the real cost you spend for the material purchased. But this concept is applicable for the interchangeability. Now, non-interchangeable means whatever the product you purchase, you are aware about the price paid only is for this material. For example, I purchased a material on 1/1/2025. Another material I purchased on 1/2/2025. This material has batch number 25 Jan. This material has batch number 25 Feb. Then if I issue product to the customer, if I issue from here, we can identify this material is for February 25 batch material. It's a new material. Jan 25 material is the old one. So we can recognize this is Jan 25 material, this is February 25 material. While selling the material from the February 25 lot, we have to charge the price for the February 25 lot only. That is called non-interchangeable. Non-interchangeable. So how can we determine the cost, sir, as per the cost formula? First, you have to follow this one, non-interchangeable method. If you are not able to follow the non-interchangeable method, then you can go for the interchangeable method. In that interchangeable method, you have to follow the historical cost method first. If you are not able to follow the historical method, only then you can go for the non-historical cost method. So very often, depend on non-interchangeable method only. It is not possible, sir. Okay, then if it is not possible, go for interchangeable method. In that interchangeable method, you have to try to follow historical cost method predominantly. No, sir, it is not possible to find out using the historical cost. Then you can go for non-historical cost method. Sequentially. First historical, second non-historical. Under historical method, two options are there, FIFO or WAP method. Sir, what could be followed first, sir? Do I want to follow FIFO first or WAP first? No. Here it's or, it's your choice. It is your choice. Similarly, here standard cost or retail price also being your choice. Hope will be now able to understand how can we determine the cost for the goods we purchased. This is called cost formula. So cost formula is nothing but method of computing cost. First, you have to go for non-interchangeable. If you are able to finalize that the cost is for non-interchangeable, then the specific identification method is final. Second being interchangeable. Second being interchangeable. Sequence based. Sequence based. Under sequence based, historical cost method will be followed. Historical cost method. Under historical cost method, first to follow FIFO method or weighted average cost method can be followed. So first choice goes to FIFO and next to weighted average method. Sequence method means first you have to go for this. If it is not possible to determine the cost under this method, you can go here. If you finalize that you choose only the first option, in that you have been given two options, FIFO or weighted average method. Between these two, you can follow what you feel comfortable. Normal consumption are usually used. Normal consumption and used regularly. Okay, based on normal consumption, you have to calculate, and the method you use for valuing the stock will be followed regularly. Non-historical cost method, standard cost and retail price method is there. Large number of rapidly changing items, but sold with a similar margin. More or less, huge number of goods are purchased and the items are constantly changing, but the GP for all these items are more or less same. Then you can follow the non-historical cost method. This is the order. This is the order. Is that clear? Now, technique for measurement of cost. Standard cost method based on normal cost and reviewed periodically. Normal cost is nothing but normal cost incurred divided by normal output. That's what about the normal cost per unit. Abnormal loss will not be considered. Abnormal gain will not be considered. Retail price method, selling price after markdown for the gross margin. So you find out the closing stock at the selling price. From there, you have to mark down. You have to remove the gross margin to find out the stock value under retail method. If the above methods result approximate cost, these things are closer to the approximate cost, not exact cost. Anyhow, we don't have any other options. We can depend on the approximate cost. In that case, we can follow standard cost or retail cost method. Clear? Now, let's start with first one. This is called cost formula. So this NDAS number main objective being providing guidance on choosing the cost formula also. Cost formula is nothing but assigning cost to the inventory. How can we assign the cost for the inventory we supplied? We can either go for interchangeable method or non-interchangeable method. So first predominantly we depend on non-interchangeable method, then you can go for the interchangeable method. Under interchangeable method, you can either follow historical cost or non-historical cost method, right? Scope. In what are the areas this particular NDAS number 2 is covered? NDAS number 2 is applicable to all inventories except financial instruments, which is supposed to be covered under NDAS number 32, NDAS number 109. These two you're supposed to study at your final, not at your inter level. Any of financial instruments like equity shares, preference shares. If I keep equity share as my stock, will this accounting standard applicable there? No, it will not be applicable there. Biological assets like living animals and plants, those things are called biological assets related to the agricultural activity and agricultural produce. This will be studied under NDAS number 41, also be not applicable for you. Anyhow, for these two reasons, these two assets, finance stocks, financial instrument and biological assets, this NDAS number 2 will not be applicable. Also, the standard does not apply to the measurement of inventory held for what? Producers of agricultural and forest products. Okay, agriculture produce after harvest. You harvested already, you supposed to sell, tentatively you are keeping. And mineral products, to the extent they are measured at NRV. In accordance with well-established practices in those industries. In case of minerals and mineral products, agriculture produce and forest produce, all these things supposed to be saleable. Until that sale, you keep this as a stock. For those things, NDAS number 2 will not be applicable. That respective well-established industries norms will be followed for valuation. Commodity broker traders, okay, okay, in case of commodity held by the brokers, right, commodity market. So that will also be not considered here. Now, what are the inventories? Already we have studied finished goods, work in progress, raw materials. Not only that, consumable will also be forming what are that. And NRV is nothing but sale value, estimated cost to completed, and estimated cost to sell. Already we discussed that. So once you finish up the illustration, almost most of the knowledge already covered. Okay, concept already covered. Fair value is the price that would be received to sell an asset or paid to transfer. So fair value is nothing but known customers and seller. Between those two persons, any amount payable for any asset is called fair market value. Known customers, they are aware about the price of the product. Okay. Now, what about the NRV? NRV already studied. What about the cost? Cost is nothing but direct material cost and conversion cost. And in conversion cost, variable is calculated per unit based on actual production. In case of fixed overhead, based on normal or actual production, whichever is higher will be taken. So these we have already studied. In case of fixed overhead, factory overhead, fixed factory overhead divided by whichever is higher of capacity or actual production, whichever is higher will be taken. The same will be there. And what are the costs will not be addable? What are the costs? Storage and holding costs will not be includable. Administration cost, especially office administration, factory administration cost will be taken, but office administration cost will not be taken. Selling and distribution cost is not forming part of the cost of goods manufactured. Abnormal cost, any interest post manufacture will not be taken as a part of the cost. Very simple. You can easily understand all these things. Storage cost will not be taken. Administration cost, especially office administration. So in case of administration, we have two administration costs. One is office administration, another one is factory administration. In case of factory administration, the cost of production only can be includable. But in case of office administration, will not be taken. Any cost after the production will not be forming part of the cost. The cost after the production being the office administration, selling and distribution. Even abnormal losses and gains will not be considered. Interest cost will not be considered. Provided this holding and storage cost related to the raw material, will be forming part of the costs. Okay, finished goods storage cost will not be considered. Unless I keep the raw material in a proper manner, I cannot do the production in smooth pace, I may get struck my production capacity also or production stream. In order to avoid that, I may have raw material stock also in my godown. In that case, cost spent for maintaining or running the godown will be forming part of the cost of the finished goods, right? And cost incurred to bring the inventory to its present location, carriage in. This is nothing but carriage in. Carriage in will be addable. Can I add that interest on borrowing, sir? Usually interest on borrowing cannot be addable, provided if the material takes substantial period to get it ready for the intended requirement. For example, in case of wine and basmati rice and dal, wine will be brewed for a few years, 3 to 4 years until that period. They invested and kept in preserve means fermentations and all process. It takes at least 3 years. Up to the 3 years for the borrowings, they may be paying the interest. No, that interest will be forming part of the cost of the material. This interest on borrowings can be capitalized up to the date ready for the intended requirement. Once it is ready for sale, thereafter not sold for 2 or 3 years, can I capitalize? No. Once it is ready for sale, thereafter you have to stop capitalizing. And of course, you will study that interest to be added as your cost under Ind AS number 23. You have that topic also in your study. We'll see in the next class. And if there is any intangible assets, if you need to have the patent for manufacturing, if you have the patent on anything, the payment will be amortized for the products and will be forming part of the costs. For like depreciation, it can be addable. Hope you will be now able to understand. How do we determine the value of the stock? Whichever is lower of cost and NRV, this is as per the prudent concept requirement. NRV is this one and cost is this one. The main point to be noted here being this one. Okay, what is that? In case of fixed overhead, it is whichever is higher of normal production and actual production will be taken, and some costs like carriage in, interest on borrowing up to the date the asset is or the stock is ready for the intended use to be capitalized, and amortization cost for the intangible. These things are capitalized and addable, and these things not addable. That's the main thing you have to understand. And joint product, byproduct already we have studied. In case of byproduct, we have to take only the NRV. This value will be subtracted from the joint costs. Joint product, a ratio of sales value at split off point or after split off point will be the base for segregation. It's not units. It's not units. Only the sales value at split off or after split off can be taken. Now, this one also we have studied. The finished product in which the raw material supplied is used sold at cost or above cost, then raw material will not be adjusted. Raw materials will not be adjusted. That's the logic. Let's see here. Cost of inventories of service provider. If this is being the inventory service provider, for the service provider, of course, he has no tangible product. Then is there any stock for him? So in that case, stock includes labor cost, including supervisory personnel if directly engaged in providing the service, and any other attributable overheads will be taken. Okay. So for example, what happens, I am rendering consultancy services. Okay. The cost for consultancy services billed at rupees 1 lakh, but currently that service is under process, not completed. As on 31st March 2025 for the year end, understand, for the year end, almost 30,000 rupees worth of labor is supported by us. And related to that services, I spend almost 15,000 rupees already. Then in my balance sheet, I can show 45,000 as my inventory value of these services. Once the work is completed, I raise the invoice and collect the 1 lakh rupees, no problem here. And what should not be includable? Labor and other costs, including administrative. Always the same way you learn for the inventory valuation cost, the same will be available here also. Administrative, office expenses, office administration will not be taken. Non-directly attributable overhead for the services rendered will not be taken. Profit margin should also be excluded. Usually cost will be shown at its own cost only. Stocks are valued at its own cost only. So profit margin, if it is included there, it should be excluded. Clear? Now, in case of cost of agricultural produce harvested from biological assets, In DS number 41, inventories comprise agriculture produce from its biological assets will be falling under the inventory. Initial recognition being fair value less cost to sell at the point of harvest. At the point of harvest. This is as per Ind AS number 41 in case of agriculture produce. That's all. So we have completed this one, and recognition as expenses. How do you recognize this as an expenses? When the inventories are sold, this is expenses. So in your P&L account, stock will be expenses once it is sold. Okay, cost of sales. If the goods remains unsold, then it will go to the balance sheet as closing stock. So you purchased for rupees 1 lakh, out of that 80,000 rupees worth of goods sold, then it will be expenses, and 20,000 rupees worth of goods remains unsold, that will be the closing stock. Is that clear? So out of that purchases, how much will be considered as your expenses? Up to the sale of inventories. Expenses in the period in which they related the revenue is recognized. If this is going to be saleable in the next year, this 20 becomes the expenses in the next year. Is that clear? That you know. Written down loss due to NRV, cost or NRV, whichever is lower. If the cost being 100, NRV is 60 and you lose 40 rupees, am I right? So you have to show only 60. You purchased it for 100, but today you are going to show at 60. This 40 rupees will be written off by debiting to the P&L account. And sometimes there is a chances of reversal also. In that case, it may be credited. Reversal of written down losses. This will be considered as income. Use of inventories for asset construction. I purchased the asset, but I later, means raw material, I converted the raw material for my asset purpose, right? So in a stationery mart, they purchase the cardboard and thermocol and all. They use the same cardboard and thermocol for false ceiling purpose. Then false ceiling is their own asset and the thermocol is the stock for them. But now the stock is used for converting into asset. Then it will be de-recognized. So expenses recognized over the life of the asset. In that case, that stock value will be amortized like a depreciation over the life of the asset. Clear? How can you recognize this stock value as the expenses? So 4 items we have discussed. And disclosures. What policies you have adapted and what formula, cost formula used you have to disclose. What is the carrying amount of the inventory, and what about the classification of your assets and stocks? Carrying amount of inventories at fair value less cost to sell. Okay, NRV. If anything shown at NRV, you have to show its fair value and the cost to sell is subtracted. At that value, you have to record and intimate it properly. The amount of inventory is recognized as expenses. How much of this inventory cost is recognized as expenses? Written down, reversal, all the things what we have learned there, you have to disclose it properly in notes to accounts form. Is that clear? What we studied earlier, you are going to repeat the same. That's all. Hope you will be now able to understand the theory also. So finish up the sums and go to the theory, you will be able to understand easily. The comparison between Ind AS number 2 and AS number 2. I actually see small aspects. Cost and carrying amount in Ind AS number recognized as expenses, such thing is not there for Ind AS number 2. Okay. To the extent of stock sold will be transferable to the P&L account as an expenses. No, that point is mentioned in Ind AS number 2, not AS number 2. Inventories of service providers given in the Ind AS number 2 but not applicable in Ind AS number in AS 2. Okay. And spares covered under Ind AS number 16 but in AS number 2 it may be dealt under either AS number 2 or AS number 10. Okay. Do you have AS number 2 and 10 studied at your CMA group 1 level? Do you have? Okay. Yes or no? So you have to compare those two. Okay. There spares will be considered as AS number 2 or AS number 10. But in Ind AS number 2, the spares, machine spares will be covered under Ind AS number 16 only. Reversal of written down value is possible here, not applicable here. Measurements of inventories held by producers of agricultural, of course, excluded. But guidance is available, but here there is no guidance at all. Here guidance is there, fair market value minus any expenses for sale. At the time of harvest, you have to measure. That guidelines is there, but here such guidelines is not there. Cost formula, consistent, whatever it may be, you can follow it consistently. Fairness possible there, okay. And Commodity broker trader, not applicable, not covered. Here it is stated it is not applicable, but in AS number 2 there is no such information. Commodity broker trader information is missing there at all. Fair value or NRV defined here and distinguished, but here such a thing is not available in AS number 2. Fair value means the value at which it is traded in the market between buyer and seller, where they have the information about the price, then it is called fair value. So with that, in the AS number 2 over and compared with the AS number 2 also. Okay. In the AS number 10, events after the reporting period. See, for the financial year 1/4/2025, 31st March 2026. Assume this is being the financial year. While preparing the general purpose financial statements on this date, whatever the assets and liabilities you have related to the assets and liabilities, some additional information may also be available after the reporting date, will have the impact on this assets and liabilities as on 31st March. For example, I have the debtors amount collectible rupees 100 lakhs. In that, amount recoverable from A being 5 lakhs, on 5th May 26, we came to know that A became insolvent. So definitely it is not possible that this amount not recoverable. Can I make a provisions on this or not is a question mark. As on 31st March, I am not aware about that, but sometimes later, before the real approval, means financial report prepared and approved, before the approval, we got some additional data. Because of the additional data, the assets and liabilities value shown in the balance sheet may be totally changing. Do I want to show this or not? Or can I adjust this, or can I make a provision, or no need to adjust? Those things are studied under NDS number 10. Events after the reporting period. Here the event being insolvency of A. Reporting period being 25-26. Because of this event, the value of debtors gets affected. How can we treat? That's guided here. The main objectives of Ind AS number 10 is to prescribe when an entity should adjust its financial statement for events after the reporting period. Do I want to adjust this here or not is going to be prescribed here. The disclosures that an entity should give about the date when the financial statement were approved for issue and about events after the reporting period. Okay. So about the date when the financial statements were approved. The approval date being say 31st July. Approval date is this one. What about the events after the reporting date? This happened on 5/5/26. Okay. Before it gets approved, we came to know then this could be incorporated here. That's our logic. Scope. Ind AS number 10 shall be applied in the accounting for and disclosure of, not only accounting of this situation and disclose this also. What? All events after the reporting period. After the reporting period. Definition. Events after the reporting period. The events may be favorable or unfavorable, then occurring after the balance sheet date but before the date of approval. Within which date? From this date to approval date. Within which date, if you get anything, this is called events after the balance sheet approval reporting period. Anything happens here, sir, it's not a problem for me. How can I know? Those things already approved and published, so we never bother about that. Before approval, if I get any data, because of the data, the financial report gets adjusted with respect to their value, then you have to handle it properly as per the provisions or policies given in Ind AS number 10. And so approval of financial statement by the board of directors in case of company, in case of any other entity, corresponding approving authority will be the date. Types of events. The events may be adjusting or non-adjusting. Some events will have the impact on the assets and liabilities value, then it may be adjustable. Sometimes leave it, don't adjust. That's how you can make the decision. Now this Ind AS number 10 guides you in what are the scenario it will be adjusted and what are the scenarios not required to be adjusted. Okay. Now, adjusting event. Recognition and measurement of the adjusting event. Especially PDD, predominantly adjusting event. Provision for doubtful debts. right? As well as NRV for inventory. These two are going to be adjusted. Cost or NRV, whichever is lower. If there is a loss, that loss should always be adjusted. So we have the stock value being 1 lakh as per my cost of purchase. Because of a recession in the market by the month of June, I came to know the value will be decreasing. The value will be decreasing. Then I had to adjust the price. Adjust the price. Evidence of such condition being existed at the balance sheet date. So 1/4/2025, 31st March 2026. On this date, there should be evidence. There should be evidence, but I cannot measure it. But the approval date assumed to be 31st July 2026. By this time, existence is confirmed. What does it mean? A's financial statement is very weak. He may go for filing of insolvency petition. In that case, we don't get any money. As there is evidence, I am not sure how much I will be recoverable, how much I can recover, how much I cannot. But on 1/6/26, he submitted and the government court judgment. The court already gave the judgment that he is insolvent. Only 20 paise in a rupee is recovered. So definitely any amount recoverable from him up to 8% will be the adjusting amount. Adjusting amount. There is an evidence as in the last date of the reporting period, and this gets affected or measured properly because of the events happening after the reporting period. But before it gets approved. Adjustments to assets and liabilities required when evidence is there on this date and events occurring this date to give the confirmation, then it should be recorded. PDD is required if debtor declared insolvent after the balance sheet date. Sale after the reporting period may give evidence for NRV. So these are the evidence we have. B. The settlement after the reporting period of court case that confirms that the entity had a present obligation at the end of the reporting period. Somebody has sued on us for any improper or substandard goods and we defended. If we lose, then what happens? We have to pay the compensation to them. So the compensation is finalized before it gets approved in the court. Then you have to make the adjustments for that. Is that okay? The entity adjusted any previously recognized provision related to in this case in accordance with Ind AS number 27. 37 will be taken. As per Ind AS number 37, provisions, contingent liabilities and contingent assets are recognizes a new provision. So these things are confirmed based on the judgment given in the court case. Okay. And the entity does not merely disclose contingent liability because the settlement provides additional evidence that would be considered in accordance with the para number 6 of Ind AS number 37. Okay. Okay. Does not merely disclose. Merely disclose. On confirmation that you are supposed to pay based on the court's judgment, you have to disclose it properly. So PDD and NRV are two interesting adjustments here for the adjustment event. Now, in case of cost of assets purchased compared with the assets sold, and if you find that the assets will be realizing only loss, then you can make a provision for that adjusting event. And profit sharing and bonus payments with the employees remains unsettled, but there will be really a conflict between the management and the employees union. And as per the court judgment, there is a payment confirmed later on, then that will also be adjusting event. We thought we have to pay the bonus. We think we may pay 1 lakh rupees bonus, but they demand, the labor union demands 1 lakh 50. Then it's in the court. As it is in the court, I thought I may give only 1 lakh, but on 1st June itself, it's confirmed that you have to pay 1.25 lakhs. Then you have to rise and show in your balance sheet as your liability. In case of fraud and errors discovered, also be adjusting event. So these are 5 items are considered as adjusting event, right? One is all about condition exists and confirmation is done after the reporting period, like PDD and adjustments of the inventory value to the NRV, and any settlement supposed to be done because of the court case also be coming under this one. And third one is asset purchased, but later on we supposed to sell. Because of sale, if there is a loss, then that loss will also be confirmation that we need to adjust this in the current year. And profit sharing bonus We thought we may offer 1 lakh rupees, but because of some legal requirement, we have to offer more than 1 lakh rupees. Then that additional amount will also be recognized on 31st March itself. And fraud and error discovered before approval of the approval, no, it should also be disclosed. And of course, these things are non-adjusting even. These things are not required to be adjusted in your uh, financial statement. Though not required to be adjusted, but at least a disclosure form you need to show, a disclosure form. No evidence of such condition being existed. See 1/4/2025, 31st March 2026. Amount recoverable from debtors being 10 lakhs, where debtor A being the main person from whom we have to receive this 10 lakhs. His financial position is very strong. Suddenly, on 1/6/2026, fire accident occurred on A's premises and A got totally lost his entire money and he is supposed to go for insolvency. Nothing is recoverable. So now, as on 31st March, such incident in evidence does not exist. We are pretty sure that the amount recoverable from A is confirmed and he is also very strong. Who knows what happens on the later date? On 1/6/2026, suddenly a fire accident happened. Almost A collapsed. Almost A collapsed. Now we confirm that we cannot recover. Do I want to adjust this loss here? No need to do. But it is a loss for the financial year 26/27. This is not the loss for the 25/26 to be adjusted here, because as on 31st March, I am sure there is no such loss will exist in the hereafter. But if there is a small doubt, A may go insolvency petition. Now go for filing insolvency petition. Then you have to be double cautious. How much you cannot recover will be finalized based on the insolvency petition filed or insolvency judgment is given. Clear? So no evidence. Loss in investment due to market fluctuation after the balance sheet date. Normal. Not required to be adjusted. I have 10 lakhs rupees worth of investment. Suddenly on 1/6/2026, the market got fluctuated. Now the value becomes only 7 lakhs. Do I want to adjust this? No, sir. Stock market value is always reacting to the market factor. So it's a normal course of action. This difference 3 lakhs is not the loss for the 25/26. A major business combination or disposal of major subsidiary after the balance sheet date. Also not decided earlier. Suddenly we made a decision not on adjusting even. Announcing or commencing the implementation of major restructuring only after 31st March. We are not thought about that on 31st March. Suddenly we made a decision. Then it is also non-adjusting even. Changes in tax rates and tax laws also be having a significant impact, also not being the adjusting even. Like suddenly GST rate is now waived by government's announcement. We are not sure such a thing may happen on 31st March. Is that okay? As we are not thought about the waiver of GST rates, that the 28% was totally scrapped, right? We are not, we don't have any idea about that. So this is also not adjusting even, not adjusting even. Because of that, if there is any DTA and detail, deferred tax asset, deferred tax liability, you don't need to think about adjusting this. Entering a significant commitments or contingent liabilities by issuing significant guarantee after the balance sheet date. Not required, not required. Commencing major litigation arising solely out of the events that occurring after the reporting period. These are non-adjusting events. So, how can you finalize it as an adjusting event? As on 31st March, there is a slight evidence, but I am not sure what's the real amount I am going to lose. But the real amount going to be lost is finalized by any event happening after the balance sheet date. So, we have the doubt and confirmed because of the event, then that will be the adjusting event. No, sir, we don't have any such evidence. We don't have any doubt, but suddenly happens, sir. No need to do any adjustments. That's called events after the reporting period. Events after the reporting period. Now, going concern. This is one of the very, very important point to be noted here. Entity shall not prepare financial statement on a going concern basis. Usually, entity should prepare based on going concern assumption. But if the management determines after the reporting period either that it intends to liquidate the entity or cease trading or that it has no realistic alternative, If the management has decided already, then you cannot record at going concern basis value. Is that okay? So, for example, you purchased a plant and machinery for rupees 1 lakh. Okay. So, car, earlier the car may be 40 lakhs. Today, because of the change in the tax rate, now it is only 35 lakhs. I purchased at 40 lakhs and showed this being 40 lakhs in my balance sheet. Okay. Now, 31st March. Because of the market value reduction due to the GST reduction, can I reduce the value to 35 lakhs, sir? No need, no need. But if the company is supposed to be closed, I'm going to operate to far higher business, rental business, car rental business. I purchased and showed this being 40 lakhs. But the next year, in a matter of 2 or 3 months later, I want to close down the entire business. In that case, I have to show the value of the vehicle at 35 lakhs only. Current NRV value will be shown. So the price what you paid will be final. From there, depreciation is subtracted and show the WD value if you are continuing the business. Okay, that's called going concern concept. If you're supposed to close that in a matter of 1 or 2 months later, then you have to show all the assets value at the distressed price or NRV value only. Okay, so usually going concern basis, but in this case you cannot show at cost value. Treatment of dividends. Dividend declared in DAS number 32 financial instrument presentation after the reporting period, not recognized as a liability. After the reporting period, if I declare the dividend, it's not going to be adjusting even in our P&L. I cannot show in my balance sheet as proposed dividend here. No need to show this, because we declare the dividend only after the financial statements date, reporting date. Okay, so it is not required to be adjusted or shown in the balance sheet as a proposed dividend. Now, let's try to solve this one. This part. Okay, this part requires some different explanation, so I will continue this one in the next class. Okay, I think this is maybe related to business combination under NDAS number 103. Most probably this component is applicable at final. Any small briefing I will give and